The first thing we recommend that all business owners know and focus on is choosing the right tax structure.
So, I mean, when you think about tax structures, what this means is how is your business going to file taxes? And how is it structured legally at a state level? You have no structure. That's a sole proprietorship. That just means that one person owns the business. There's not an LLC or a corporation, and that just gets taxed on your individual tax return. It's the simplest way to do it. This is good for kind of like hobbyists and people who have maybe a small side hustle, something like this. That's a sole proprietorship generally. If you're running a real business as a sole proprietorship that's making significant income, tax planning and structuring is very important. The next kind is going to be a pass-through entity, and there's a couple different types of pass-through entities. The most common are partnerships and S corps. Now, a partnership is generally going to be an LLC with multiple members, but it could also be other types of state legal entities, like an LLP, an LP, something like this can be a partnership. And a partnership is great because you have the most flexibility through your operating agreement or your partnership agreement about how the money will be distributed out to partners and how income or loss will be allocated to partners. Pretty much, if you can dream it and it has economic effect, you, your lawyer, and your accountant can make that happen. The next version of a pass-through entity is an S corp. And you hear a lot of people talk about S corps. We like S corps, but only for certain types of businesses. S corps aren't great for every business type. But the reason that S corps are good is because you can limit your exposure to self-employment tax by only paying self-employment tax on what's deemed a reasonable salary. So an S corp is a very popular strategy, but it's also not the right type of entity to hold certain things. So for example, if you have real estate in an S corp, that's probably not a great structure. Okay, but if you're running a professional services business in an S corp, that might work. But there are reasons that it still may not be the best. So every situation is different. The last kind is a corporation. And when I say last, I don't mean this is all-encompassing discussion. The last most common type is a corporation. S corporation has the word corporation in it, true. But what we're talking about when we say corporation, that's a C corporation. C corporation is its own taxpayer. The other ones are all going to be taxed at the individual level. But a C corp, as its own taxpayer, will pay corporate tax, which has a flat rate of 21% federally, state tax potentially, and all of them actually could have state tax implications, but it'll pay its own state tax. And then if there's money that's going to get distributed out to the owners of the business, it's possible that will be taxed as a dividend, so a second layer of tax. So a corporation can be one of the more expensive ways for tax to be structured, but not always. It kind of depends on, again, what your cash flow looks like and your plans for the business.